Okay, good afternoon, everybody. Today is Friday, May 19th. This is your weekly take on the market. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Testing. And I apologize. I want to make sure I was recording. You guys could hear me okay. It sounded weird to me. Anyways, let's get back on track. Please take a moment to read the disclaimer. Any stocks I talk about shouldn't be construed as investment advice. I'm not licensed. Nobody at IBD is licensed. We don't make buy, sell, hold recommendations. Our circle of competence is research and education. That being said, the webinars are vetted for compliance, so we are allowed to speak a little bit more freely on a webinar versus an email, etc. Okay, so we'll talk about the overall markets. We'll go to the industry groups, stocks to watch, and then the quote of the week. So I do have a few slides, but I'm going to do it differently this time. Let's go straight to the indexes. So let's talk about the indexes. And I'm going to turn my camera off in case I'm covering the price action. So this isn't quite up to date. The market just closed about 15 minutes ago, so the volume might be a little light, but the price action should be very good. And we had a really strong day yesterday and today. Although it was a little weak, it wasn't that weak. It's actually kind of doing what you'd like it to do. 3 steps forward, 2 steps back. There's a lot of controversy about this market. It's very narrow. Everybody and their mother knows that. That's not a surprise. It's all I hear about is how narrow the market is. So it's built into the price. Obviously, we'd rather have it a little bit more broad, but it's funny. I was talking to Rusha, and we were talking about how narrow the market is, and I said, well, if we only want to own 5, 6, 8, 10 stocks, why do we need it to be so broad? And he kind of looked at me and thought, yeah, why? But we'd rather have more options, more possibilities. But if it's narrow and strong, then you're just gonna have to find where the leadership is. We know where the leadership is. Doesn't mean we're gonna be able to handle it correctly, but the leadership is sticking out like a sore thumb. So I don't know how to interpret the overall market. It's not easy for sure, but like if this was the only thing you were allowed to trade, pretend you're in a vacuum, and this is the only index or product you could trade, and you had to be long or short. You can't be neutral, so you're always either long or short. I think 98% of you would be long this, right? Based on just the fact that a series of higher highs above the moving averages, et cetera. So, that's the market is acting. It's okay. It's not great. It's okay. There's nothing that sinister about it. And there is, some bad news out there, the debt ceiling overhang and stuff like that. So it's actually holding up pretty well in the face of the debt ceiling, higher interest rates, stuff like et cetera. Let's go to the S&P. Not as strong, but strong enough. It had a okay day yesterday. I think it underperformed the NASDAQ. The S&P, last I heard, was up around 8% for the year, and the NASDAQ's up like 25%. A huge dichotomy between them. And I think the Russell and or the Dow are flat, give or take a few percent. And so it's been one of those markets where if you're not in the right stuff, Google, Nvidia, Apple, even Tesla's acting a little bit better, you're just going to be underperforming. And that's okay. You can't, I don't want to say can't, but it's very difficult to beat the market every year over year. And especially if you have a downside protection process like we do. So a lot of the outperformance by the in-house portfolio managers at William O'Neill, I would guess, I'm not privy to that completely, but it's from the avoiding the big downdrafts. So like in 2008, I think I've heard Scott O'Neill say they were down 3%. So what was the S&P down in 2008? So in 2008, right there, that's roughly the start. So let's just say 1500. And by the end of the year, wow, almost at the lows by the end. Let's just go with about 920. 38% and change, 39%. So if you're down 3% and the S&P is down 39%, that's massive, massive outperformance. So if the S&P is up 20% here and you make 18, and it's up 7% here and you make 6, and it's up 12% there and you make 11, but you lose 3 here, and this you only lose 3 and it loses 38. So the S&P in this window, and I'm not drawing this perfectly, but in this window is basically unchanged, maybe down a little bit, and you made double digits 3 times and only lost 3%. So Matt, you're really pounding the market. So you can underperform the market in good years, just avoid these really bad years every once in a while, and then sprinkle in, like the portfolio managers have done, you sprinkle in a 2020-ish market every once in a while, even if it's every 8 or 9 or 10 years, where you really hit it out of the park, where you're firing on all cylinders. That's how you can grow your accounts, just doing it like that. Well, that's the way I like to approach it. It's fun. It doesn't bother me one bit to underperform the markets in certain years, and then once in a while pound the market, and then when it's really bad, avoid it. So like for this year, I'm up pretty good in my speculative margin accounts, more faster accounts, that because I just got lucky on a couple of shorts. I had I had a handful of bank shorts, but I had 2 of them, literally open at 0, practically pennies, and they were 10% positions. So there's 10%, that's 20% in those 2 alone. Nothing that I did. I just knew a guy that I thought does good work, and his thesis made sense, and I put the risk on and managed it, and it was pretty easy because they just kept going down and down. But in my IRAs, I'm underperforming the Nasdaq for sure, and I think I'm beating the S&P by the tiniest of margins. But Nasdaq is kicking ass and taking names. Nasdaq's blowing my doors off. If I'm up 10 or 11, it's up 2.5-fold. And if the year ended tomorrow, that'd be fine. I'll worry about, and we'll try again, rinse and repeat. So let's go to, we looked at the NASDAQ. Let's look at the Dow. We don't look at the Dow too often. Not that great. And then we'll look at the Russell. So if this was all you could trade, and you had to be long or short, oh, that'd be really, really tough for me right here. If I had to be long or short, I don't know which side I'd want to be. If I could be neutral, I'd be neutral. This would just be an avoid. So it's been one of these kind of weird markets we're only halfway through, and allegedly Confucius said, "May you live in interesting times," which it's fun, it's interesting, it's not easy, it's frustrating for sure. Sometimes can be, really frustrating, but it's a very stimulating intellectual game, and I think that's probably why we all like to play it, for lack of a better word. Okay, so let's jump into some charts. I really love this chart. This took me by surprise. So somebody tweeted, I don't want to hear about the advanced decline, the breadth of the market anymore, because the NASDAQ advanced decline has always underperformed the NASDAQ. This chart is just incredible. So look at that advanced decline line versus the NASDAQ. So I wish I'd seen this chart a few years ago, or at least at the start of the year. It might have changed my thinking a little bit about, the health of the market. Because if you use just this chart, you'd think, well, the market's unhealthy, it can't keep going up. And look at, as the advanced decline line cratered in the 90s, that was one of the best times to be investing. And it just kept making lower and lower lows, even as the NASDAQ turned around. So this is a really interesting chart. Margin debt is pretty poor, and we need margin debt to really add fuel, to really push the market. Markets do better when there's people are on margin. It also is kind of a signal of the animal spirits, that people and institutions are willing to take on risk. I think, and I'm kind of in that camp too, a lot of people don't want to take on a lot of risk right now. And it's showing by the margin debt, is very low. You can see now it can peak and get extreme like it did in 99, 2000, and in 08. But it's all the way back, if this is to scale, the 05, 04, 05, 06-ish area. I talked about this on IBD Live. I know a lot of you wanted to see this, this care sheet, I guess I would call it. And I kept this from when I was a broker, RTE Asset Management. I think I got this probably in late 99. I don't even know if RTE Asset Management is in business, but I have to give them credit for kind of big picture thinking on, that the markets could change, time to be wary, risk control. So you could buy America Online, had $113 billion market cap, and that was just incredulous at the time. 113 is nothing now. Talk about inflation. You got Apple's what, 2 and change trillion, and Nvidia's on its way to $1 trillion, it seems. And but at this moment in time, you could have had America Online, or you could own McDonald's, Sears, Fruit of the Loom, Apple Computer. Look at that. Remember, Apple Computer one time was on the verge of bankruptcy. It's the markets are fluid. What you see now will be totally different in 20 years. So be open to anything possible happen. Hilton Hotels, Land's End, Dow Jones, Kmart, Pep Boys, Vlasic Foods. The Washington Redskins, I guess they just sold for $4.5 billion, rough 4.6 billion or something like that. You could have had them for 800 million. Harley Davidson, look at how much gold and silver you could have owned. Italian lira, $1 trillion of that. Eggs, you get the idea. And still have $500 million left over. I hope I just didn't get signed out. I apologize. That's why I paused. I got a message that I've been signed out. I hope nobody tries to use the account. I'm going to proceed as if it's working. So I think the message for me is that not that things are overvalued or like that, but that there's two messages. One, you want to let your winners run. And you don't have to be right all the time. If you own the Redskins and Apple, or even just Apple Computer here, but imagine you bought all of these. Some of these went out of business. Sears is gone. I don't know what happened to Fruit of the Loom. Kmart is gone. Pep Boys, I don't know if they're gone. Maybe they got merged into AutoZone or something of that nature. I don't know the story. The lira is gone, but you probably got converted to euros. But even the fact that some of them went away, imagine you did this trade, is just totally incredible. McDonald's, Apple, the Redskins, the amount of gains. And so you don't have to be right all the time, and just be fluid and have an imagination is the key, a vision that things can change. They can change for the better, then change for the worse. And everything that you see, some people, I think they get themselves in trouble by assuming that the world is so static, like that all these great companies, can't go bad. I was reading about the guy that founded BlackBerry, what a genius he was, and he couldn't pivot. And the people in BlackBerry were telling him about the iPhone, how strong it was and the features it had, and he just couldn't pivot. He didn't have the imagination, the vision to pivot and stay the course. And BlackBerry ended up getting left behind. So be open to that. Be flexible. Be willing to pivot and change, both for the good and the bad. The market's hard right now, and a lot of people might think, well, it's got to make a new low. It don't got to do nothing. And there's no way the market can make a new high. Oh yeah, why not? Why can't it? Why can't it make a new high? So I'm not saying that you have to bet that it's going to do that, but be open and flexible that anything can happen in the stock market, because it has throughout history. All right, so let's open up MarketSmith. Let's get to the industry groups. Okay, so computer software education, building residential. So far, so it looks pretty similar to last week. Computer hardware moving up the food chain, 17-3. Computer software database, 9-4. Gold is losing its luster. No surprise to me. Like I've said 100 times, right when you think gold's going to really go, that's the end of the move. Maybe one day that will change, but I'm telling you, I've for 20 years, that's been the story with gold with me. I'm very wary of when it looks good. Internet content, beverages and alcohol, leisure travel. So I just don't see a lot of signal in the industry groups like we'd prefer. Wish there was one group to just, go-to group, software or semis or something like that. All right, so stocks to watch. I have quite a few that I felt were interesting, worth talking about. So let's start with First Solar. Oops, wrong ticker. Am I? Okay, sorry. And it just jams on this news that they're buying a European company. It's up 26.5% this day, right into new highs. Looks like kind of an island bottom and everything. And then it just bleeds 1, 2, 3, 4 every day. Every day it just goes lower. And this is kind of the problem, with stocks. There's no oomph. Now it's up 26% in one day. It probably deserves to do this. Maybe even this. If I owned it, I might be able to. I could live with this, maybe this, but just to give back the whole gain is too much. It's too frustrating. I didn't own First Solar. I don't own it, but I was watching it, and this is kind of why probably in general most people are a little cautious on the market, because this type of stuff tends to happen. ON. I guess we'll start with the bad stuff. So it gaps up on earnings, and then gaps down on earnings. And it's hard to have a big winner. Like Jim Rope will say, you got to sit through 2 or 3, beat and raise quarters to have a really big winner. Well, this was a beat and raise, and then a beat and guide down, and it gave it all back. I don't remember who was telling me, maybe, but somebody, I have not really traded on. I've always been a little skeptical of it. It just from the eyeball standpoint, I just don't like a lot of Twitter eyeballs on my stocks unless it's really, really big. So Nvidia, Google, and they're not going to influence the stock like that. But this one seemed a little bit overowned by the traders, by the fast money, and so these guys and gals they're going to get out. They're going to You're going to shoot first and ask questions later. And so when it gaps down, there's your sell signal. Now, how would, if let's say I was in this, how would I handle it? So and it wouldn't matter where I owned it. I could own it here or I could own it there. If I'm in it and it gaps down like this, I usually will hit the bid very, very early in the day, like the first 5 minutes, maybe even on the open with 20, 25% of my position. So you have 1,000 shares of on the open. I think you need to sell 200-300, something like that. Just get rid of it. Just sacrifice those 200-300 shares and hope it's a terrible, terrible trade. What happens if the low is, it opens at 30. I'm just going to say it opens at 30, down 5. You got 1,000 shares. You give them 200 or 300. You sell 200 down 5, and the stock closes unchanged. Well, you're unchanged on 800 shares. So on a day where the stock at one point was down, 20% or something, you only lost $1,000 on that position. That's to me, that's the best way to handle these gap downs. Now, by the end of the day, if it cannot overcome any of the gap down, then I'm going to be out of at least half, if not more. If I own it here or here, I'm just going to dump it and then reset. Tomorrow, the next day, 5 days later, I'll just reset and buy it back if I think so. If I own it here or something, maybe I'll try to see if this is a shakeout for one day, but I'm going to give it the market. I'm going to sacrifice some more shares. The very next day, it's gapping down. You just got to puke it and be done with it. Now, wait for a new base or some kind of thing like this. But that will help you to not get frozen if you find yourself frozen on these types of things. Sacrifice a handful of shares and hope it's a bad sell. If you sell the low, so be it. You still have 80% of your position or 70% of your position. And it allows you to get in motion, because once you do some selling, let's say here I sell 200 shares at 31.50. Well, a few hours later, the stock is 30.50. Well, I can remember that. Well, that was a good sell. Boy, I sure wish I'd done more of that. Maybe I had to sell more at 30.50. Let's do some more. Sell more at 30.50. It closes 30.19. So now I've got two good sells, two sells that are higher than where the stock is. You see the feedback I'm getting? Looks like selling is the right way to handle it. The stock is continuing lower, whereas we do this with buying. We buy, stock's higher, oh, guess I should buy more. Stock's higher, guess I should buy more. So if you can't bring yourself just to hit the bid on the open, I try that approach. I think my experience is 80% of the time I wish I'd sold it all. But I know how psychologically difficult that is for people to do. So get in motion, make yourself a rule, at least 20%. I would say probably more, but at a bare minimum, 20%. I cut no matter what, market order on the open, and then see what happens. Let's see here. What else? Sell H. So this is holding up really well. I do not have a position in it, but acting really well. FTNT, I might have talked about this. I talked about it on IBD Live. I don't know if I talked about it on my video, but I really like the shakeout. Looks like it's going lower. And then the big day on earnings right there, up 79%. And if I open up the panel, Fidelity is increasing their position. Look at that, 7, 1.22, 2.15. That's really good action. And you can see here, increasing fund ownership. I click this button to show fund ownership. Let's see who I have flagged. So there's Contra, Pharmacist, Fidelity Advisors, Harbor. So there's a few funds that have a position in this one. I do own FTNT. This is interesting to me. Huge base right here. It's very, very close to coming out. Now, I have to understand how FTNT trades. It's not a runner. It's a slogger. It's like the turtle versus the hare. This is the turtle, and it wins the race when it's good. There's nothing wrong with 31 to 67. That's a double. It took a number of months, but what's the hurry? So, and I like this area. It's big, it's liquid. It's not quite NVIDIA, Tesla liquid, but it's that second tier. And if the market gets better, if the market starts to expand a little bit, this is the next level of stocks the institutions will go to. They can only buy so much Microsoft and NVIDIA. They've got to own other stuff. And this has, it's CanSlim Superstar. EPS rating 99. Return on equity is super high, but that might be debt related. So, take that with it's not quite like that. But look at the quarterly earnings. What's that? 5 in a row, accelerating. The revenue is solid, 34, 29, 33, very, very good. And then last but not least, I almost forgot. We added a column here on the weekly chart called forward PE. I don't know if this is something I will use. I'll explore it. I'll think about it, but I know people have asked for it and they want more data points. And, on this weekly chart, I'm not a, CFA charter holder or anything, but there are some things that I don't think are necessary. Book value, inventory turnover, new CEO. Look, if there's a new CEO, we're going to stamp it on the chart here. So there's room for adding items. And so I've been looking at what are some items that people like to, like return on invested capital is something that a lot of people like as far as a metric. So we'll try to slowly but surely, for lack of a better term, modernize some of these data points, because I just don't think they're that relevant anymore. So forward PE is here. FYI, if that's something that you would be interested in, you'll find it on the weekly chart. What else? ACLS broke out. Very good action. Couple of shakeouts and then right back up. The earnings on that day. So a little shakeout on earnings. So, hey, I don't know if this stock gapped down or not. Let's pretend it did. This would be a good example. It gapped down, you had 1,000 shares, you sold 200. By the end of the day, the closing range was about half. You might be able to survive. Wait that out. The next day, it's up. Next few days, it's up, it's up, it's up. Well, buy that 200 shares back. That's how you could survive that little shakeout. And this one has ownership as well. And then Rambus broke out of the space, kind of a base on base. I know Mark Minervini's talked about Rambus. I don't know if he still owns it or anything, but sure is acting well. And then let's go to the big boys. So NVIDIA is the most hated and loved stock. It might be close to maybe Tesla's still one, but NVIDIA is too. A lot of people are upset at how well NVIDIA has acted and how expensive it is, and that's gobbledygook in our world, right? So here's what's the forward P for NVIDIA. It's 93. The current PE is 95, 5 times the S&P. So coming out of this base, it's extended for sure. But I talked about how I bought this stock 2 or 3 weeks ago on a mental health buy, like David Ryan would talk about, or what I would call a probing position, very small. Just go buy 50 shares, 100 shares in a couple of accounts and just have a position and see what happens, because it just was so hard to buy. And there was a day, see if I can find the day. I guess I could look it up, but I think it was in here where the market was down May 4th. The NASDAQ was down 0.5%, down 58 points. And what did NVIDIA do that day? Yes, this is the day I bought it, right there. So the NASDAQ was getting hit, and I just watch NVIDIA, of course. And it's like the best at one point, I think it was down $3. I'm like, this is the most overowned, most overvalued stock in the market, allegedly, right? And the Nasdaq's getting hit, and the best this can do is go down $2-3. And that was enough for me. It just won't pull back. It's one of those stocks that just won't pull back. Now, I didn't have the guts to buy a full position because I was buying it a little bit out of, not out of a base or anything like that. But at some point, sometimes you just have to kind of hold your nose and buy it and be willing to take a little loss on it, just reduce the size. Yesterday, I did sell some of it. But again, today, like today's action was not all that great in the market. It wasn't terrible, but it was not that great. But NVIDIA was only down 1% today. So you go up 5 and you're down 1. I don't know. I think there's a chance this thing could just run and run. And so, and if I'm wrong, I'm going to give back most, if not all, of my gains. But I'm open. My imagination is wide open that there's a lot of people on the sidelines that don't own this stock, that maybe the institutions are just in this must own. And if I'm wrong, if this is like some kind of crazy top, well, then I'm going to, give back the gains. It's not that big a position. I'll give back the gains, and I'm not going to ride it all the way down. But it's hard to know. This action this week is compelling. Is this like a breakout of something big, or I'm excited to fast forward 6 or 9 months and see how this plays out. I honestly, I think it could be like this over a number of months, or if the market gets in trouble, this will be the best signal, because this will start to go down. If NVIDIA and these start to go down, then you'll have a really good clue that the rally is over. But at this point, I think you want to give the stock benefit of the doubt. Tesla, I can't bring myself to buy it, unfortunately, but I don't want to be short it. It just doesn't look like a short. Today, the market was down, Tesla was up. These are little clues. I'm not convinced it's a buy, but I just don't see it as a short. Apple has a little bit of that NVIDIA niche. Like, it just, can't go down, just stair-stepping higher. I won't buy this because I just don't see any growth with Apple. It's just too big. From a market perspective, you own Apple, you own NVIDIA, it's probably one and the same. Maybe you'll lose in NVIDIA a little faster than you would in Apple, but you'll win a little bit faster if you get it right. Microsoft, does that look bearish? Google. So I don't own Google anymore, unfortunately. I just got wore out. But see, that to me would be like a little short-term sell signal, just because of the way I trade. Amazon. And then there's some others that, like the old stalwarts, ServiceNow, breaking out of this cup with handle, looks very good. I don't own that. Kind of wish I did. ASML, I do own. Axe looks good. Breaking out. There's one other that I wanted to highlight. I lost my train of thought. Gosh darn it. One other very important stock. Snow. So Snow looks interesting to me. I do own Snow. They do have earnings in a few days. Now I have to admit, I kind of own it probably because it was so good to me in this run right there, from there to there. So if it wasn't Snowflake, I don't know if I would own it. I'd probably wait. Like, I don't own Shopify or Twilio or any that are building these kind of bottoming bases. But Snow is now super overvalued stock, way up there. Great metric for are the institutions willing to put on risk. And so if they're willing to put on risk, this is the kind of stock they'll buy, because so you have 4 weeks in a row up, earnings in 5 days, but this is interesting. I'm really interested to see how it plays out with the earnings. But like the monthly chart, this is how these really big stocks, they go public. They kind of, for lack of a better term, crash and burn. They find a bottom, and then you fast forward 6 or 9 months later, and they're incredibly higher. So like, let's see, look at like Team in 2016. So this is a monthly chart. So it tries to go up, it can't. Bottoms, and then this is the beginning of a big move right there. In April of 2017, it's 30, and then $30 to $400. Incredible move. What was the Team? How about Ring? I think was one, Ring Central, right? So it crashes and burns, tries to go up, and then when it makes a new high like that, just runs and runs and runs. So these new names, they gotta have to kind of grow into their valuation. Who knows how long I can stay with that, but that's what this kind of setup looks like to me. All right, so let's get into the quote of the week. Might be the most simple, shortest quote of the week I've ever had. Prices are never too high to begin buying or too low to begin selling. From Reminiscences of a Stock Operator. I'm going to presume most of you have read this. Probably a lot of you, including me, have read it more than once. I don't know, couldn't even count how many times I've read it. And it's just, with all due respect to William O'Neill, How to Make Money in Stocks it was the book that kind of, started me on my path. But as far as thought process and everything, this is the best book out there on the stock market. And it's a kind of a pseudo biography of Jesse Livermore. And this is kind of goes to like Tesla, maybe 2 or 3 years ago, one that I missed because I always felt like I'd missed it. It's too high. I've missed it. And then doubles and doubles. Or Nvidia currently, right? It's too high when I bought it. It's not coming out of a base. It's not on the moving average, but it was just the leader. And you turn around and 2 weeks later you're up 20 some points, or what the number might be. And the other way, ON, gaps down, I can't sell it. Next day it's down, I can't sell it. Next day it's down, I can't sell it. They're never too low to begin selling. Prices are never too high to begin buying or too low to begin selling. This will keep you out of trouble, something like that type of mindset, and allow you to get into some of those leaders that you really want to own. You can feel it in your bones that that's the right stock to own, but it always is so hard to buy. Start with a smaller position, just get in there, get a probing position or a mental health buy or whatever you want to call it. Just get yourself in it. Once you own it, it's a lot easier to add to. All right, contact information, marcusmith@investors.com, 800-424-9033. And I forgot to mention in the beginning, a lot of feedback, a lot of emails. I really appreciate it. You guys are great. One guy sent something, I can't remember. It was I don't think it was Yogi Berra, but it was a famous professional athlete, or 40% of the people will love you, 20% of the people will hate you, and the rest are indifferent. I thought that was a great quote, because that's really probably the truth, right? Have a great weekend. We will see you all next week. Bye-bye.